All right, well, let's get started. Welcome. My name is Roger Ballard, CEO for Nuvision Credit Union, and I'm really glad you're here. We are committed to empowering our members with knowledge and tools so that they need to be successful financially. And that's really the reason behind why we're doing this economic forecast series. We're calling it a series because we're doing a number of them. We did one back in March, and we're doing another one. And well, at the end, I think we'll talk about the one in September. I'll give you the exact date. So we're really glad you're here. And this series is just an example of our dedication to providing you with valuable resources that we hope makes your decisions in your life that much easier. And we're really excited to have a great expert on the economy with us this evening. And participating in this webinar should give you knowledge necessary to make smart financial choices that align with your goals. So I know if you're like me, you can read and listen to a lot of different viewpoints about the economy, a lot of different narratives. So we're hoping that this information is really helpful to you. So be sure, we're also going to have some Q&A during this session. Chris and I will kind of have some dialogue with mostly Chris, Dr. Thornberg, giving most of the commentary, but I'll be facilitating, and we will be taking your questions. And to submit a question, you can simply use that Q&A button and submit your question, and we'll try to get to those as many as we can. And be sure to watch for email updates and announcements. So we'll be continuing to announce these webinars and can offer follow-up if we have your email as well. So our main speaker here is an expert on the economist. His name is Dr. Chris Thornberg. He's earned national recognition for his expertise in economic forecasting. His accurate prediction of the subprime mortgage market crash back in 2007 showcased his deep understanding of economic trends and their potential impact on the economy. His insights will help you stay ahead of an ever-changing economic landscape. And certainly it does feel like to me it's changing very quickly and often. And so, it's part of our conversation that we're going to have this evening. I realize some of our members may have participated in the first webinar that we had, but we know some might be participating in this webinar for the very first time. So we'll try to do some recap of some of the background so that you wouldn't have to be a part of that March webinar to have full value here. So Chris, we're really glad you're here. Thank you for being with us. We did have, it looks like it was back in March 8th of 2023. We had another webinar, and our first one, and you had some great information to share. But if I was to recap at least my takeaways from that, I think after you provide a lot of great information, that my takeaway was that in your view, the media narrative was that there's going to be a recession soon at that time. This was back in March, but in your viewpoint, you had a lot of great supporting points. You didn't think that would be the case, at least back there in March. Yeah. So now we're here in June, about 3 months later, and I know obviously with more time, there's more data and maybe more reflection on your part. So what do you see for the economy as we sit here today?
Absolutely, and Roger, thank you for that introduction. I apologize if you're wondering why the screen was moving around. I had actually put up last presentation, as a matter of fact, so I almost gave you exactly what I was talking about back in March. But I realized I had the wrong slideshow up. So I shifted to the new one. And, God, it seems like yesterday, but 3 months have gone by, and actually pretty consequential 3 months, as the case may be. We've obviously had the failure of 3 big banks. The New York Times, of course, talked about how these 3 bank failures in total asset value was as big as all the banks that failed during the Great Recession. Of course, we just went through that debt ceiling chaos, and it looks like we've squeaked that one out. But it has been a long 3 months, even if it doesn't feel like it, as the case may be. So with all that in mind, look, this is kind of the big picture I started with last time. And to be honest with you, things haven't changed all that much, but we do have a lot more data. I think it largely backs up a lot of the things I've been feeling. But again, it also doesn't leave us, what do I say, with that warm, fuzzy feeling, because there are still challenges in front of us. Of course, the big story last time was what I call the differences between social narratives and economic realities. And I'll come back to that kind of towards the end of this presentation. But we always have to keep in mind that what you read in the paper, what you might hear coming out of that bully pulpit is not necessarily the same thing that I see on a day-to-day basis when I'm looking at the data. The big narrative, of course, the big picture over the last year, over a year now, is that we're about to have a recession, right? It just goes on and on and on. Every time you turn around, that continues apace. So, and the reason for this, of course, has to do with the fact that everybody out there in newspaper land and news land and politics land is positive the economy is already in some sort of tragic crisis. Now, what crisis that is, I think it depends on what party you belong to, but we all know that everybody's in this crisis mode. But the big stories of the last 12 months, 15 months have been, of course, the big increase in inflation and the subsequent increase in interest rates. The story, very simple, is that, or the narrative, very simply, is that inflation is crushing the consumer, interest rates are crushing real estate, ergo, we're going to have a recession. And by the way, these banking failures we saw, whether we're talking about Silicon Valley Bank or First Republic Bank, these are simply a sign of the underlying rot, not unlike the bank failures we saw during the course of the Great Recession or going back at the beginning of the 90s with the savings and loan problem. What I said last time was very simple, is this narrative is functionally incorrect. And because the narrative is functionally incorrect, the predictions that people are making because of it are also functionally incorrect. Look, inflation and rising interest rates are not a negative shock randomly hitting our economy. Rather, these are the direct consequences of the excessive stimulus put into place over the course of the pandemic. The story is that inflation's crushing the consumer. The reality is excessive consumer demand driven by that stimulus is exactly what's pushing inflation. The difference there is critical. If you think of inflation as an exogenous shock, it's bad for the economy. If you recognize that inflation is being driven by internal conditions, then you realize that what this is really, again, more of a reflection of policy at the Federal Reserve level rather than a reflection of anything underlying inherently bad in our economy. Indeed, from my perspective, over the many years of looking at the economy and economic cycles, I've started to realize that what we need to do is take a step back from those financial indicators and really look at the real world. Because when I'm thinking about calling a recession, what I'm always looking for is, where is that real shock going to come from? Where is the decline in aggregate demand that's going to drive the imbalances that we cause a recession? I don't see it in this economy. I just don't. Now, it doesn't mean we're completely out of the woods. I expect inflation is going to continue to run hot. Asset prices are going to continue to deflate. But the underlying strength of our economy is pretty apparent. When I get into some of the recent data, you will see that backed up quite clearly. Now, the long run issues, the bigger issues we have to be facing are the issues that, for the most part, are the ones we're not talking about. For example, the big increase in interest rates and what I would call the collapse in liquidity in real estate market. There's a collapse in liquidity, not a collapse in the market. I'll explain the important difference there. Is going to intensify housing shortage in many parts of the United States that are dealing with these issues. Labor shortages are an enormous issue across the United States, but of course, particularly in some of these West Coast markets, for example, in California or in places like Alaska, where the job openings rate is up at record high levels. We have public deficit challenges. I don't care about the debt ceiling debate. That is a complete red herring to the true underlying problems with the federal deficit, which are enormous. And we need to start getting serious about it before, of course, those bond markets turn on us. We have the pointless bank credit crisis that could cause a recession. That hasn't gone away because the Federal Reserve is still sort of in the shadows, if you in almost what I would call not a good way. They're out there. They continue to worry about the wrong things. Almost assuredly, they're going to be pushing policy in ways that could actually create a recession, the one that they're trying to avoid. But of course, the scariest thing of all is, again, this gap, the gap between what we're talking about and what's actually going on the economy today. Now, let me do this. I'm going to back up real quick, kind of go through some of the backdrop of this, how we got here. This is a recap of last time, but then I want to quickly get into some of the current data. So as you all know, I call it the Godot recession. If you all remember the play Waiting for Godot, of course, by the way, this is an alert. If you don't know the end of this film, you might want to mute for just a second here. But it turns out Godot never shows up. Now, of course, and this has to do with the existential silliness of life. In this case, it's about the existential silliness of, if you will, economic reporting. We've been hearing a year of this data. And to be clear, there is some stressors on our economy. As already noted, we did have the big surge in inflation. The good news is it has cooled off, although it's still running hot. Big pop in interest rates. Mortgage rates are running between 6 and 7%. The collapse in consumer confidence. Of course, we had the inverted yield curve, which is a strong sign of an oncoming recession. Well, if you believe in numerology, this is a function of correlation, not causation, which I think we need to come back to. Oh, by the way, I should also back up and explain what an inverted yield curve is. A yield curve is the difference between long-run and short-run interest rates. When short-run interest rates are higher than long-run interest rates, we call that an inverted yield curve. And to be clear, if you go back to the last 4, 5, 6 recessions, you will find that prior to those recessions, we see an inverted yield curve. This is why a lot of folks who look at the inverted yield curve are predicting a recession. One of my favorite predictions is, of course, the Conference Board. This is the Conference Board. The Conference Board does the leading economic indicators. This is their current recession probability. And yes, your eyes do not deceive you. The Conference Board currently has a 100% chance of a recession occurring. That is what I call a degree of confidence that no economist should ever have. But again, that continues to be in the headline. And yes, the bank failures. But to put it all to one side, let's take a look at where our economy is right now. Here's probably the biggest piece of news we've gotten from, of course, the last time I've talked to you. The last time we chatted was in March. At the end of April, we got our GDP number for the first quarter of the year. And lo and behold, it came in really, really strong. Now, I know the headline number was only 1.1%, but you know, that 1.1% reflects the growth in aggregate output, GDP growth. That's not actually the best indicator. A much better indicator is what we call final demand. What's the difference? Well, GDP measures growth in output. Final demand measures growth in what we call spending by government, business, and consumers combined. How can these differ? Well, there's a couple ways. One of the ways these two things can differ, of course, is through the course of, say, a trade deficit. If consumers spend more, but they buy it mainly from imports, then what you have is a situation by which, yes, actually the economy may not grow, but spending is growing. So they're a little bit different. The key here, of course, is that demand drives supply, and if final demand growth is strong, well, that's a pretty good sign that supply will start to catch up. Well, that's exactly what we saw in the first quarter of the year. While overall headline growth was about 1%, underlying final demand growth was well over 3%. The gap was a very large rundown in inventories. That's a temporary situation. Again, to put this in context, that 3.2% growth in final demand in the first quarter was the strongest number since 2021 when we were recovering from the pandemic. If anything, we're coming into 2023 with an accelerating economy. And by the way, probably the most important number in that list of spending, well, personal consumers, it's consumer spending, personal consumption, which added well over to about 2.5% to the overall 3%, well over half of overall GDP growth. For all the conversation about inflation hurting consumers, about rising interest rates hurting the consumer is alive and well and continues to push the U.S. economy over. And there's plenty of other signs that the economy continues to do well. We just got the May jobs number, and we added 300,000 jobs. There was a minute bump in unemployment, but it still remains well below 4%. Industrial production, actually, after sagging just a little bit in the first couple of months of this year, actually has started to pick up again. If anything, it looks like the economy has completely blown off the increase in interest rates and the hike in inflation we've seen and continues to move along. Again, pretty good data on the economy. Now, how do we get into this weird space where everybody's telling us it's the end of the world, where the economy seems to be doing just fine? How are we ending up with inflation? Well, it goes back yet again to broken narratives. The broken narrative that started this, of course, had to do with the narrative way back in 2020 when the pandemic hit. Now, the pandemic, it's in the rearview mirror now, but we all have to acknowledge what a tragic period it was. Millions of people passed. We were stuck inside for a year. It was an enormous situation from a social standpoint. The problem was that the stories about the economy became highly off base from anything looking even remotely reasonable about what was going to actually happen. 30 to 40 million people going to be evicted, 10 years of depression and debt, 30% of people defaulting on their home loans. It's a depression-like crisis. None of this made any sense. Look, the pandemic was tragic, but it wasn't an existential economic shock to the system. It just wasn't. But don't let reality intrude on a good narrative. Congress picked up all those scare stories and ran with it like crazy, and they ended up throwing $6 trillion in debt-driven stimulus at the economy. $6 trillion. Now, context is helpful. Take a look on the left-hand side. This is data on potential GDP versus actual GDP. And if you look what happened over the course of the pandemic, you see that big shock, but also how rapidly we came back. Overall, the U.S. economy lost about $1.2 trillion of economic output over the course of the pandemic. And to repeat the number I just gave you, in return for that particular economic problem, Congress did $6 trillion of deficit-driven spending, $5 in stimulus for every dollar of economic loss. This is completely off the chart. Now, one of the things to ask is, how did they get that money to spend? All debt levels in the United States expanded by about $3.5 trillion in 2019, $3.5 trillion. Now, in 2020, all by itself, Congress borrowed over $3 trillion. Had Congress gone to the bond markets in 2020 and tried to borrow that money in a normal fashion, say the way they did in 2019 by going to the bond markets for the $1 trillion in deficit spending then, well, they would have tanked the bond markets. They never would have been able to raise that cash. Interest rates would have gone through the roof. The bond markets would have been uncleared. It would have been chaos. The good news for Congress is they didn't have to go to the bond markets. They just had to go to the Federal Reserve. Now, the Federal Reserve is supposed to be an independent institution, but that independence has clearly been whittled away over the last 15 or 20 years. And the net result of that is we now have a Federal Reserve that largely behaves at the beck and call of Congress. Congress says we need money. Powell said, how much? And sure enough, they ended up with $5 trillion in quantitative easing. Now, yet again, a little terminology here. What is quantitative easing? Well, it's a fancy way of saying we're going to turn on the printing press and we're going to use brand new dollars to purchase government debt. It's really kind of an accounting gimmick. More or less what they did was they printed $5 trillion and Congress spent it. They fire hosed it across the economy. Now, this is no different than what Ben Bernanke did back, of course, over the Great Recession when he did about $3.5 trillion of quantitative easing. So it's not an unknown tool, but the use of this tool couldn't be more different. Ben Bernanke did $3.5 trillion of quantitative easing over 6 years. And he did so in response to an actual financial crisis in the United States. Why did you have to do that? Well, Ben Bernanke is a student of economic history, and what students of economic history know is that depressions aren't caused by pandemics. We've never seen that happen, and we've seen some pretty serious pandemics hit the United States. The Spanish flu, for example, was much worse than what happened over the course of the COVID situation. But again, no sign of a quote unquote depression. What does cause a depression is a combination of a bad recession with deflation. Now, deflation is a period of time where price levels are falling, and they're falling largely because of some sort of monetary contraction going on inside the economy. And that's a real problem at the best of times. Inflation is a very difficult for economies to deal with because of what we call price stickiness and wage stickiness. So we want to avoid it. But during the course of a recession, it can be absolutely deadly. Because it makes the recalibration of the economy at the back end of a financial bubble collapse that much more difficult. And that's exactly what was going on during the course of the Great Recession. We had an enormous problem in the banking system because of all that debt that was handed out at the end over the course of that run up to the Great Recession started going bad. And we had bankruptcies and foreclosures and banks started going down. And all this was deflationary. Ben Bernanke said, I have to prevent deflation. And he did the $3.5 trillion in quantitative easing to avoid that. The problem this time, there was no financial crisis. Take a look on the right-hand side. This is some data from consumers, no foreclosures, no bankruptcies, no failing banks, no major institutions going down. In fact, the world from a financial standpoint was remarkably clean. As a result of that, as opposed to offsetting deflationary pressure, the only thing that actually happened is the excessive amount of money throughout the economy caused one of the sharpest expansions in money supply we've ever seen. Take a look on the left-hand side. This is M2 growth. M2 is a broad measure of money supply. You could look at the 1970s where we had, of course, high money supply growth, and we know we had a lot of inflation. Well, this time around, an even bigger hit overall to the money supply. And yes, of course, with that huge expansion of money supply, we had this, what typically happens in terms of these issues, the problem of excess money, as the case may be. Now, there's another wonderful book out there. I mentioned this last time, Money Mischief by Milton Friedman. Some of this knowledge here I've taken from that book. You should buy it. It's a wonderful read on Amazon.com. But when you overexpand the money supply, oh, I'm sorry, let me back up just a little bit. On the left-hand side, I also want to point out, over Bernanke's use of quantitative easing, there was almost no growth in money supply. He kept it nice and constant because the quantitative easing was offsetting the deflationary effects of the financial crisis. This time, no financial crisis, huge spike in money supply growth. What does this do to the economy? Well, in the short run, what it does is create a situation called money illusion. Hey, so a bunch of money showed up in your bank account. Well, I feel rich. What do you do when you're rich? You spend and you invest. Well, by investing, interest rates go down and asset prices go up. By spending, of course, the economy starts to grow at a very solid rate. In other words, it feels great. The problem here is this feeling of wealth is not real. Real wealth is created, of course, by expanding the capacity for an economy to produce more. That means investing in capital, adding workers, training workers, investing in infrastructure and institutions. Throwing a bunch of money at the economy doesn't change the underlying capacity for the economy to produce goods and services. All it has done is push demand beyond, if you will, supply. And when there's more demand than there is supply, we know what happens. Prices go up. Well, this, of course, is the money supply hangover. In the medium term, that excessive amount of demand turns into inflation. Inflation turns into rising interest rates, and everything starts to unwind. You basically see everything going back to where it was. Asset markets sag back to normal levels. Spending starts to sag back to normal levels. Indeed, what you find is you more or less end up where you were. By the way, that's important. Nobody ever said that inflation causes recessions. We have no evidence of that. So why does the Federal Reserve care about inflation? Why do a lot of folks counsel against inflation? Well, the answer, of course, has to do with the long-run impacts of inflation, because in the long run, if you continue hitting that inflation accelerator, what ends up happening is you create big disturbances in the underlying economy, which have negative impacts in the long run. One of those big hits, of course, has to do with the transfer in wealth from savers to investors. That, of course, leaves a bunch of losers, which means we have big political problems. And for those particularly who are getting close to retirement age, they follow themselves falling behind, creates problems. It also creates a lot of financial risk, which can reduce the overall level of real investment. And of course, that also hurts the economy. This is why Milton Friedman called his book Money Mischief. He said, don't do this. It's bad for the economy in the long run. Have an independent Federal Reserve, resist the temptation to do that. Well, that's exactly what we didn't do. Now, how this operates, of course, has to do largely through the wealth effect. Wealth overall takes off. That, of course, causes the increase in spending. What's interesting, this is not the first wealth bubble we've had in the last 30 years. We had the dot-com wealth bubble. We had the subprime wealth bubble. Now we have Jerome's quantitative easing wealth bubble. But this one was a little different than the last ones in as much as it was cash driven, and a lot of that cash went to the bottom 50%. In other words, this one turned into consumer demand very, very quickly. Hence, it turned into inflationary pressures very, very quickly. And that's exactly what we've seen over the course of the last year. Now, with inflation kicking in, interest rates coming up, asset prices have started to come down. But what's interesting is how slow they've actually come down. What's interesting here is how little actual rebound or if I say kind of collapse we've seen. Take NASDAQ, which has probably seen some of the biggest decreases in overall asset values, yet it still is substantially above where it was pre-pandemic. The Shiller price earnings ratio for stock markets still suggests that stock prices are actually slightly overvalued still, not even slightly, pretty well overvalued. So yes, asset markets are unwinding, but slower than people might think. Again, there's no surprise here. The only surprise is the fact that we come up with these silly explanations for inflation. It's supply chains, it's the deficit, greedy corporations, manufacturing jobs, green energy policy, rising wages, the war in Ukraine. Inflation is always and everywhere a monetary phenomenon. But again, this narrative is not just welcome in our world today. Our world is in the midst of what I've been calling miserableism. And in the miserablest world, people are falling behind. We've all heard this, right? 75% of families are struggling to get by, living paycheck to paycheck. And in that world where we constantly have to reinforce that view, even if it isn't true, you can't stay up and say the truth, which is the reason we have inflation, is because consumers are trying to spend too much money. It doesn't fit with the common political narrative, ergo they toss it out. But it's the right reason we have inflation. And if you don't recognize that, you start pursuing the wrong policy goals. And, I talked about this last time a little bit, but it's worth reiterating. One of the places where you can see how this is not supply, but rather demand is in what happened with gasoline prices last year. If it's the supply argument, right, that's all what we heard. Last year, we had a 50% increase in gasoline prices. We were told it was all because of supply effects. But if it was really just because of supply effects, well, if the supply curve shifts back and price goes up because of that, we should also see a reduction in quantity being consumed. That's how markets operate. Well, last year, we saw a 50% increase in gasoline prices. And by the way, vehicle miles driven didn't change at all. They stayed perfectly steady. And that tells us that, yeah, okay, there were some modest supply disruptions, but the key here was overall consumer demand for gasoline was so high, it didn't matter. People bought the gas and they went to where they wanted to go. And by the way, that also tells us why when oil prices started coming down, inflation didn't go away. Because when it's demand driven, you recognize that if people spend less money at the pump, they only spend money somewhere else in the economy. Look, coming into this year, it's pretty clear consumers continue to have a lot of fun. Las Vegas, as busy as they've ever been, even without a full return to the convention business, or of course the Chinese whales flying in to spend a couple fun nights in Vegas. Spending in restaurants right now is 40% higher than it was pre-pandemic. 40% higher. Think of that for just a second. People are having fun. Auto sales have been bouncing back. Actually, since we last talked, consumer durable spending was a big source of growth in the first quarter of the year. But mind you, there's still pent-up demand. Overall inventory to sales ratios in the auto markets remain remarkably tight. Now, for those of us who are telling us that inflation was hurting the consumer, they continue to go to the income argument. Look how much savings rates have come down. Look how real disposable income has fallen because of inflation. Well, by the way, those effects are starting to fade. Savings rates are coming back up. Overall real disposable income is also starting to come back up. In other words, the income argument, well, it seems to be fading away. How do consumers survive through this? Well, as noted, what's been driving spending is not incomes, but net worth. We recently got some data from the fourth quarter of last year. And just take a look on the left-hand side. Households at the end of last year still have $30 trillion, about 22% more in net worth than they did prior to the beginning of the pandemic. Tons of money. On the right-hand side, checkable deposits, money sitting in your savings account. Prior to the pandemic, all American households together had about $1.1 trillion in deposits sitting in your credit union or your bank or in a box under your mattress. Well, again, as of the fourth quarter of last year, catching us up, households still sitting on $4.6 trillion in cash liquidity. This is what's driving consumer spending right through that, shall we say, decline in disposable income. People are sitting on piles of cash, and that's what's driving the economy forward. And it's not just the top 5% or 1%. The bottom 50%, their net worth is up over 100% from where it was pre-pandemic, 50th to 90th, up 130%. There's a lot of cash that's supporting consumer spending, and it's supporting the economy, even in the face of inflation and rising interest rates. And you see that in some of the data here in Southern California. Overall, the share of population with a subprime credit score continues to fall. I already showed you the data on people with foreclosures and bankruptcies. But what about all those scary stories you're hearing about consumer credit and credit card debt? Well, yet again, most of that is, well, just not true. Take a look at some of the data. We just got Q1 data from the Federal Reserve for consumer credit. This is from the New York Fed Consumer Credit Panel. Wonderful data. Credit card debt is growing a little faster than normal, but only because it declined over the course of the pandemic. It's still getting back to trends it was on pre-pandemic. Overall credit card debt, auto loans, still incredibly clean. The financial obligations ratio is still near a record low level because most consumer debt is in the form of a 30-year fixed rate mortgage. The stresses on American households aren't what they're telling you in the paper. In fact, households still look remarkably clear. And as far as that goes, guess what? Even housing has been bouncing back. I know housing was supposed to be everything that was wrong in the United States. Remember, mortgage rates went from a little less than 3% to 7%, and the housing market went incredibly cold. But in the last couple months, sales started to pick up. Median prices stabilized. According to the Case-Shiller, we've seen 2 months of home prices rising. The new home market, inventories of new homes for sale are falling. New home sales are up. Housing starts have stabilized. How much more data can I show you to tell you how this economy is doing? Okay, it wasn't that. And that's true here in California. In fact, many markets across the West Coast. Now, what happened with the market, of course, is it went really cold because prices went up a phenomenal amount, of course, in the run up to that, at the back end of all that new money thrown at the economy because of quantitative easing. And then interest rates went up. And suddenly the sticker price that didn't seem so bad in 2020 looked really bad in 2022. And as a result of that, the market cooled off tremendously. It just became much harder to buy a house. But the fundamentals of the housing market couldn't be more solid. Debt to equity ratio is about as low as they ever been. The quality of that debt, about as good as it's ever been. Household equity, enormous amounts of household equity, $30 trillion floating around the United States right now. And of course, the overall market is incredibly tight. This is not the kind of housing market that collapses the way it did so spectacularly during the Great Recession. This is more like the housing market we saw in the 1970s, where, of course, in the face of rising interest rates, it just got cold, right? But even that, again, unlike the 1970s, where that was a persistent condition, this market seems to have sloughed off to 7% moving forward. Again, if you look at mortgage markets, they remain remarkably clean. And by the way, the fact that you've seen a decline in liquidity in the resale housing market is why apartment markets look still so strong, because there's a tremendous amount of consumer demand. I can't jump into finally buying that house I wanted, but I want a nicer apartment. Indeed, even businesses. Let's go back to what some of the things that are happening here. For corporate profits as of the fourth quarter of last year started rising. We've just been through the earning for the first quarter, and outside the banking system where there were some hits, corporate profits still are remarkably good. Proprietor incomes continue to rise. The bond market distress is still relatively low according to bond market distress indices, again, courtesy of the New York Fed. Businesses will tell you, even coming in to the middle of 2023, their biggest issue remains job openings, the lack of labor. It's interesting because overall, the labor markets have been cooling off. But by cooling off, we could say that the overall job openings rate went from about 7.3% to a little less than 6%. But to be clear, prior to the pandemic, the hottest labor market we ever saw was in about 2018, where the job openings rate was 4.8%. And sectors like leisure and hospitality, education and health, wholesale trade still see very, very high overall job openings rates. These are sectors that'll tell you, I don't have a problem with demand. I have trouble meeting that demand. Now, where all the workers go? Well, we talked about this last time, no point in reiterating it, but it all goes down to demographics. Baby boomers all came out of families of 10 kids, all had one kid. Now that boomers are retiring, you have one Gen Z coming into the workforce unhappily for every boomer that's starting to retire right now. That, of course, means that you're just not seeing growth in the labor force. We need to support long-run growth in the U.S. economy. This is something this nation desperately needs, of course, to deal with, primarily through a big change in immigration system. But again, that conversation's not happening anywhere. The reason this became so profound right now, of course, has to do with the fact that a couple million people retired over the course of the pandemic. Now, remember, one of the big things that's been supporting consumer spending has been that big increase in wealth. But it's not just wealth, it's also income. Those tight labor markets have actually had a profound impact on wages. Wages in the United States have been growing the fastest we've seen for 30 or 40 years. Now, some of that is inflation related, there's no doubt about it, but a lot of it is in real terms. Take a look at the left-hand side. This is real earnings growth for American workers, and I've divided the workforce into what I call the top half of earners and the bottom half of earners. The bottom half earners right now, as of the most latest data, which is coming into early 2023, the bottom 50% of workers are seeing a 2% real increase in wages. They've seen that over the course of the last year, but the top 50% just got back to 0% after, of course, seeing their real earnings hurt over the course of the last couple of years. Yet again, a lot of money getting pushed into the bottom 50%, both wealth and income, and that's turning into consumer demand. And that, of course, is exactly what's keeping both inflation moving hot and, of course, the U.S. economy moving forward. So strong consumer keeps a strong economy, and that's what you're seeing. The downside, of course, is, well, it's becoming expensive to run those particular businesses. Business compensation costs are going up. The cost of non-supervisory employment is going up. You remember I just told you about those restaurants that have seen a 40% increase in the retail sales? Well, believe it or not, restaurants don't feel like they're doing well because most of that 40% is going to higher food costs and higher labor costs, not to that restaurant owner's back pocket. And that's one of the reasons why they're not feeling that, shall we say, the positivity that would come out of that number otherwise. By the way, that labor shortage leaves us with one other upside for the economy: strong business investment. If you don't have enough people, what do you need? You need machines. And what we saw yet again in the first quarter of this year was another big jump in overall real spending in particularly key areas like software, research and development, information processing equipment, manufacturing equipment, stuff that is there to obviously offset labor shortages. New order for capital goods continues to be very strong, all positive sides for the economy. Who's ahead? Who's behind? Well, this brings us up through the beginning quarter of the year. And, look, you have places like Nevada that are up 7.6%. You can see Arizona up 5.4%. California, middle of the pack, up about 2%. Other places, Hawaii is down as the case may be. And it's easy to look at these and say, oh, that economy is good and this economy is bad. I live in California, which means every time I turn around, I have to listen to Governor Abbott and Governor Newsom talk about, who's got the bigger, stronger economy. And candidly, it's a little bit exhausting as the case may be. It doesn't matter where you are in this nation. There's one thing all states have in common, and that's an increase in, of course, help wanted signs. Take a look at a place like Alaska. Alaska's job opening rate at the end of last year, we haven't gotten 23 data yet, is 10%. 10%. That's up 4 percentage points from where it was pre-pandemic. There's nobody to employ. California, well, we're up 2.2%. Arizona, well, they're just up about 1.7%. If you look at it this way, Alaska's not the strongest economy and Arizona's the weakest one. How do you square this? Well, yet again, you have to remember that this relationship is not being driven by labor demand, but being driven by labor supply. Remember the true narrative, the right narrative. If you look across these West Coast economies, Arizona, California, Nevada, Oregon, all of them have one thing in common: a big increase in the job openings rate. And it all boils down to who is adding labor force. Where are people moving? Now, dealing with labor force constraints is the fundamental conversation that has to happen when it comes to any kind of economic development conversations. How do we expand our labor force? You have to do it in the short run by getting people to move there, or in the long run by encouraging more babies, as the case may be. In the short run, you got to raise your participation rates. And of course, yes, you got to help companies, particularly small mom and pop companies. You got to help them do more with less by integrating sort of information technology into their business operations. We continue to hear stories about how AI is coming for your job. Realistically, we need AI now more than ever, particularly if we're not going to fix our broken immigration system. And coming back to Newsom versus Abbott, well, again, the story about Texas versus California can be summed up in one graph and one graph only, and that's on the right-hand side. It's all about housing permits. Now, I just want to take a little bit of a step back because there's another big news story, particularly here in California, but I think it's relevant for other places as well to think about this. What have you heard about California's population base over the last couple of years? Population is falling in the state of California. And you've heard all sorts of reasons why. Oh, it's the business climate, it's high taxes, it's unaffordable housing, as the case may be. But back up for a second. Again, this goes back to narratives about supply versus demand. On the left-hand side is California's housing vacancy rate, which is, by the way, at a record low level. Record low. So how is it that if people are fleeing taxes, fleeing unaffordability, fleeing regulations, if businesses are moving out of state, how can it be we have a record tight housing market? How does that work? Look, if you have a record tight housing market and population's declining, there's something else going on. And we recently did a study for LA City. It's a little bit specific, but work with me just a second. It's kind of interesting. LA has seen a tremendous amount of population outgrowth, about 4% over the last 4 years. And yet, take a close look, apartment vacancies are falling. Housing vacancies are falling. Again, one of the tightest housing markets ever seen. How do you explain falling populations and falling vacancy rates? The only way to explain it is through falling number of people per household. And this goes back to the heart of this story, particularly when it comes to homelessness, which is such a crisis issue across California and in much of the nation right now. And the story is rents are going up faster than household income, renter incomes, ergo people are ending up homeless. That's the wrong story completely. What's happening is renters are doing so well that they're expanding. They don't want to live with roommates. They want to live by themselves. They don't want to share a house with another family, and they're expanding. And this is causing a decline in people per household. And by the way, if you are not directly benefiting from this hot economy, and there's always a portion of people who are not, well, these people are being squeezed out of the system. It's hot demand that's causing homelessness. And until you acknowledge that, well, you're going to continue to go the wrong way on dealing with this particular issue. It's supply, not affordability. And the only way you're going to solve these problems is build. So there's a bit of an update, Roger. I went through a lot of stuff there, but I can't tell you enough, whether you're talking about consumer spending, the housing market, or all this different incomes. I mean, everything says this economy, business investment, this economy is moving forward great at a good pace.
Great, Chris. Great information. And you're right. You did cover a lot. And I wasn't the last one. I saw another member also was, but we had some new folks, a lot of information, a lot of great information, a really great point to kind of the logic you share flows quite elegantly from my point of view. Why don't we, if it's okay, why don't we take maybe a few questions? I've been watching as you've been talking. We've got a few questions that are kind of in the queue that I can call out. Some of them we might be able to do full service, but we'll do our best. And in some cases, we might be able to follow up, especially I know in some cases, I won't call out the names, but I see names around some of them. Others are anonymous. It's a choice. But just as a reminder.
My chair is getting tangled up here. I'm about to fall off my chair. So I'm just trying.
Okay, go ahead, fix that. We don't want you falling off because then I'll have to answer all the questions and I won't be near as good as you. So please take care of your chair. But just as a reminder, either for this or we'll do another break toward the end here, we have a little bit more content to cover, but we're going to take a pause, take some questions. As a reminder, if you want to submit your question, just click on that Q&A icon and you can type your question. I believe you have an option of either submitting it, kind of anonymous or with your name. So let's just see if we can take a few of these, Chris, if that's okay. Is your chair okay?
Yeah, I'm good. I'm all good. I'm good.
Okay. All right, good.
Yeah,
So I'm like looking at two screens here. And some of these I can try to help with, but I'll just go kind of in order as I see I'm getting close. Thoughts on drawing from 401ks now at today's tax rate with penalties versus drawing at a tax rate decade. So I think a lot of this is,
that's a
kind of
long
expectations, for taxes. And
Roger,
normally we would recommend people not incur the penalties unless they have some sort of like really significant personal situation. But do you have any thoughts? Because I think inherently
we're
kind of wondering about tax rates.
Yeah, we're going to talk about that in a few minutes because we still have a huge federal deficit problem. And I think that this is exactly what Jeanette's getting into. So let's hold that. Let's save it for the end of the conversation.
All right.
Because it is
Sounds
really
good. Yeah. Great idea. Another one, how is central bank digital currency going to affect my funds at Nuvision? I know I actually did a session. I think I may have shared this with you, Chris. We called it Nuvision Insights. We're going to do a few of them this year. And I got a similar question. And at least as I understand it, the Fed is just doing kind of a pilot project, right now. So my point of view is I'm not aware of any near-term impacts at all. And I think it's just more of an experiment, kind of a learning pilot. Right. But in case you might have any perspective or maybe additional information to share on that.
Not really. Yeah.
Okay.
I think you're right. It seems like a pilot program at this point in time. We're going to be interested to see how it ends up shaking out.
Good. So someone, I'm going to ask this, but knowing you're not a financial planning expert, but I might be able to follow up. But I want to acknowledge all the questions. Somebody, a member retired, left an employer-related 401k with an investment company. This happened to be T. Rowe Price. I've been told that I should not leave it where it is, but should roll into an IRA. Can you please comment on this? So if you have any comments on that, otherwise of this, and I do have the member's name here, I'm not going to state it here, but we, at no cost to you, we also have financial advisors, and you don't have to do anything with Nuvision with this, but who might be able to help you with this question as a follow-up. So at minimum, I'm saying this out loud for the member and for our staff who can, if they can track a follow-up for me on this. But Chris, any point of view before I go on that?
Yeah. There's a real issue in the financial world, particularly with these Wall Street companies, that keep in mind that we've never actually gotten a fiduciary duty law passed. Okay. So you get a lot of advice out of folks and they give you a lot of hard arm twisting. Be really, really cautious about what you hear directly from the good folks at T. Rowe Price. Take advantage of the credit union's offer of financial assistance, get a third-party view on this as to what some of your best options are. In general, a lot of times, a lot of these funds claim, if you will, a degree of expertise or degree of alpha, as they call it in the biz. It doesn't really exist. And more often than not, what you're looking for is simply low overhead and index funds. That's how you keep safe. But this is not really about, if you will, financial planning. I would, again, back up what Roger said. Go talk to your credit union and have one of those folks help you.
Yeah, and we'll do a follow-up again at the member's option if they'd like to talk. No cost, no obligation. We'll just at least give you someone who has a lot more expertise certainly than I do. Another question, and I think this sort of something I was going to ask about, and maybe you're going to get to it later, but I'm going to state the question and maybe just broaden it a bit if it's okay, Chris.
Yeah.
The question is, will inflation cause political crisis as it did in Germany in the 1920s? That's the question. And if I may add, just again, feel free to defer. Just one thing I don't think we talked, and I know we covered a lot, was just a little bit about geopolitical, kind of risk and just inflation across the world. And I even thought a little bit about China, not so much some of the military tensions, although that's a factor, but what China's the second largest economy. So anyway, I'm broadening it, but I want to make sure that we get the members' question first and foremost about is there concern about political crisis, caused by the inflationary rates as it did in Germany in 1920 is the question.
Right. And it's a great question because to me, it highlights, if you will, that social narrative versus some basic economic realities yet again. The political crisis that came out of German inflation had to do with hyperinflation. And in hyperinflation, you're talking 500% per year to 1,000,000% per year, right? You're talking about people with wheelbarrows of cash trying to buy basic things, a collapse in the basic economy. And you could think about, yes, Weimar Republic, Germany, all the way up through Zimbabwe a few years ago, which had a similar sort of problem. This isn't that. What's amazing is when you think about the surge in inflation, the actual PCE inflation, that is to say, the real inflation rate for consumers, peaked at about 8%. And it's already come down. It's 1 year of inflation. Even in 1979, after 5 years, we had seen 50% increase in consumer prices. This time around, after 5 years, we're talking about 18%. What's funny to me is how everybody's been calling this an inflation crisis. Yet as far as inflation goes, this is really, really moderate. We've had one little spike in inflation. It's already starting to cool off because the Fed's backed off and has stopped quantitative easing. This isn't the issue. It isn't a problem for our economy. In fact, a little inflation is a good thing. A lot of inflation is a bad thing, but a little inflation could be a good thing. And if the data I've showed you to date hasn't proven it, I would argue that the little bit of inflation we've had, particularly since it's progressive inflation, it's helping the bottom 50%. It actually has a bit of a positive bump for our economy. And we need to stop pretending that this thing is inherently evil the way that Jerome Powell runs around talking about it.
Yeah, because I think the Fed, what is it, a 2% target inflationary rate?
Why?
Somewhere. Yeah.
Why?
Yeah.
And by the way, this is a great entry point into the second part of my presentation.
Let me get to see if I can get to a couple, and then again,
One
if
more,
it
and then we'll
fits
jump.
in,
Yeah.
and I am watching time too. Someone was asked to see, so I got that one, or Christy did. So inflation. Someone's well, here's a question, and you might have. I know I have an opinion, but it's obviously individual decision here. But Chris, I'll invite your opinion first. The member saying, should I wait until 2024 to purchase a home to see if prices and the interest rates come down?
I would say if you can wait, right? I don't think prices are going to come down, right? I mean, it might, and we'll come back to that when we start talking about the Fed, because that's the next big question. But in theory, your best bet is to wait a couple of years if you can wait a couple of years. And here's why. In this kind of market, okay, go back to the idea of price stickiness, right? That's what I said. Why is deflation so dangerous? I said it's because of price stickiness. Well, that's what you see in housing markets, right? Housing prices hardly ever go down in nominal terms. And that's because homeowners, because of price illusion, because of price stickiness, whatever it is, they're remarkably unwilling to accept nominal losses. So there's not many homes out there for sale. And the people who are selling, for the most part, probably have options because they have money, they have equity. And they're kind of in this world of going, yeah, you don't pay my price, I'm not selling, right? And in that kind of world, prices remain elevated. And if you have to buy right now, you're probably going to overpay. You're probably not going to see a lot of appreciation over the next couple of years. But if you can wait a couple of years for interest rates to come down, for, if you will, that real value of the home, because remember, inflation depresses the real value of that home over time, well, then you're probably going to be better off from a return standpoint. But with all that in mind, the other part of it is this, is if you're making your life miserable by waiting 2 years, life's too short to remain miserable. You got 2 kids, you got twins 3 months away, buy a house. It's worth it. Even if you don't get that same maximum return you might get, buy something you can afford and deal with it, understanding in a few years you can move again. Just don't make yourself house poor. That's what my father, the real estate agent, always said. Don't overbuy. Buy what you can afford, but if you need to buy, you need to buy.
Yeah, I think that's a great point. You made that last point was what I was going to bring up. Lots depends on your kind of current quality of life
Yeah.
situation. And
Yeah.
sometimes it's just and there may be an opportunity in the future to also refi. Obviously, we do a lot of home loans. So that's another option. My own
Right.
daughter was kind of in a situation with her family. First home, should I wait? Should I not? Low, but they were not in a situation with a young one that, they wanted to live like that. So they bought. And they're happy they did. And, because it was a quality of life and affordability, they made the affordability work, but it was a quality of life issue. I think that last point is great. I think, Chris, we have a number of questions, but I think I'm kind of watching time too. So what I'm wondering is if we might kind of shift to the final content, and I'll come back to these and maybe others that I can kind of pick. The ones we don't get to, we'll try to do a follow-up, at least where we have the member's name and give us the email. But one thing you referenced a little bit earlier was you mentioned the banks and some of the issues briefly in your earlier comments. And I'm just, trying to kind of get your, I read a lot about this, the banking concerns. In fact, we actually did a webinar kind of focused on this not long ago and answered member questions. But I also read a fair amount about concerns about credit tightening. You talked about how the Feds, did quantitative easing. Now they're doing quantitative tightening and, shrinking their balance sheet. And so just trying to get a sense of what's the impact of banking and the current Fed banking issues, the current credit. I hear some about even, and I saw a question in here about concern about commercial loan portfolios, especially among some of the banks, especially on those maybe portfolios, properties that were financed variable rate when rates were much lower, and now it's, kind of coming up. Anyway, I know that's a lot. Kind of what's your viewpoint, and kind of I'll let you finish out the rest of your content, and we'll see if we can get to a few of those final questions.
It sounds great. And let me go back to one of the things you just said, which is the Fed, they want a 2% inflation rate, or we want a 2% inflation. That's all he says. Yeah. We have a 2% target, and we're going to have a 2% target. And by the way, they haven't gotten to 2%. Inflation's cooled off. There's no doubt about it, but we haven't gotten to 2%. Why? Well, again, part of this has to do with why we have inflation in the first place. Obviously, too much money floating around the economy. And what I have here in front of you is a little bit of metric. We call it unit money supply. It's basically M2 divided by nominal GDP. And it's a good way of thinking about how the money supply relates to overall price levels, right? If you increase the money supply, just again, take a step back and think about in a vacuum, holding everything constant. If you doubled the money supply, in theory, all prices should double as well. And the economy is exactly the same, right? If I just went out and I replaced a $2 bill for every $1 bill in the economy, prices would simply double, everything would be the same and nobody would notice. So ultimately, thinking about the amount of money relative to the size of the economy gives you a sense of where inflation pressures are. And by the way, inflation pressures are still there because there's still a lot of money. Even going back to that number I gave you earlier, where households are sitting on $4.6 trillion household cash balance, almost 4 times what it was pre-pandemic. And yet again, you recognize that cash is king, cash is driving anything, and that cash will continue to move this economy forward until, of course, in real terms, that cash balances start to get back to normal levels. Well, by these metrics, just looking at the money supply, we're about halfway through the inflationary surge, despite all the Fed's efforts. Now, most of the Fed's efforts, of course, have been involved with cranking up the federal funds rate, which is an interbank lending rate that banks use to keep their deposits and their basically their balance sheet aligned with technical requirements on the part of banking regulations. And they've been cranking up the federal funds rate. It's a little bit above 5% as of the May meeting. And yet we're still haven't gotten to 2%. Well, that's because all this effort they're doing here about cranking up this interest rate, the federal funds rate, doesn't actually change the money supply. It's a second order effect. It barely budges M2, which means the only thing you're doing by cranking up the federal funds rate is really slowing down the pace of price adjustment, not the end target. Look, if you need 30%, if you have to have 15% more inflation, whether that's going to occur in 1 year or 3 years may depend on the federal funds rate, but you still need to have that 15% inflation is the way to think about this, right? Now, that, of course, brings me to the inverted yield curve. Remember, we talked about that earlier on, and we talked about this being this great indicator, and the conference board says we have a 100% probability of a recession because of the yield curve. Why does an inverted yield curve typically show up prior to a pandemic? Well, the answer is because it's the Federal Reserve that's driving the yield curve. When you see an inverted yield curve, almost invariably, it's because the Federal Reserve is pushing up short-run rates, and eventually they get higher in long-run rates. So it's a bottom-up kind of push. Why is the Federal Reserve typically pushing up the federal funds rate? Well, it's because they're trying to deal with some sort of economic issue that they're worried about. If you go back to example, in the late 1980s, we had inverted yield curve because the Federal Reserve was nervous about what was happening in terms of commercial real estate lending, or the dot-com situation, or the subprime situation. And all three of these cases, you did have, of course, those short-term interest rates coming up. The only time we had an inverted yield curve that wasn't caused by the Fed was in the run-up to the pandemic. And I got to tell you, that is one of the kookiest correlations I've ever seen in my entire life. It's just completely random. Did the yield curve predict a pandemic? Between you and me, I don't think it did. Okay. I would just say that out loud. I think that's random. But this time, one of the deepest inverted yield curve, we know it's being driven strictly by Federal Reserve policy. Now go back to, say, 2005 when we saw the inverted yield curve, because the Federal Reserve was panicked about subprime lending and they were trying to cool off the market. Well, guess what? It was too little, too late, and we had the subprime meltdown recession anyway. In other words, when I see that inverted yield curve in 2007-06, what I see is skid marks at the edge of the cliff. The Fed saw the cliff coming. They put their foot on the brake. It wasn't enough and went off the cliff anyway. It's a sign of the failure of the Federal Reserve to do what they should have done earlier on to prevent the problems from happening in the first place, not a sign that we are going to have a recession no matter what. Now, does that mean, again, goes back to this idea, what does the inverted yield curve mean right now? And look, just to have a little fun here, I like to say that as an economist, I think about bigger issues than just the economy. For example, does free will truly exist in a Newtonian universe? Or, for example, why is there a D in fridge but not refrigerator? These are deep questions. Is it possible for an atheist to get insurance to cover acts of God? We don't know these things. But if the Fed inverts the yield curve and the economy is otherwise fine, will it cause a recession? Because that's the question that has to be in everybody's mind right now. I gave you all the good news, but you have a 100% probability of a recession according to the conference board because of the yield curve. What does this boil down to? And of course, let's not forget those banking failures. What is going on? Well, this has to do with the other part of the Fed system, which is quantitative tightening. And this is where things get a little scary. Look, there's two ways of pushing inflation down. One is to try and cool off the economy to the point that inflation subsides to that level. The second thing, of course, is starting to engage in quantitative tightening. Now, remember, quantitative easing is where the Federal Reserve prints money and buys government debt. Quantitative tightening is where they sell off that debt. And take a look on the right-hand side. We saw a 40% increase at M2. M2 has now come down 4% because of about 5% now because of quantitative tightening. So they are shrinking the money supply. And this can truly reduce inflation. This can actually cool things off. Here's the problem. There is a secondary issue with this method that they have not been paying enough attention to. And that, of course, all has to do with how it impacts the banking system directly. Now, first, let's go back to the question that you asked at the very end of that, where somebody said, hey, what about commercial real estate portfolios? Isn't the banking system going to choke on all this bad debt? Take a look at the left-hand side here for a few seconds. This is the bank charge-off rate in the United States. And this is just commercial banks. The credit union data, unfortunately, is a little bit lagged. We don't have Q1 yet, but it's exactly the same picture. Look, the charge-off rate is the share of debt that's being written off as bad. In the course of the Great Recession, at one point in time, in each quarter, 3% of bank debt was being written off. Ouch. No wonder the system was just falling apart and credit was tightening up. It was a mess. Today, we have the cleanest credit union credit situation ever, the cleanest commercial bank situation ever. There's no problem with loan portfolios, none, zero zip schultz, nada. They are clean. Well, then what happened to Silicon Valley Bank? What happened to First Republic Bank? Well, the question about what happened to those guys, well, you have to ask the Federal Reserve. Look, what happens when, of course, I'm sorry, back up. When the Federal Reserve engages in quantitative easing and tosses $5 trillion of brand new money at the economy, they give it to Congress, Congress fires it out. I don't care where that money went, okay? I don't care if it went to an airport, if it went to a low-income family, if it went to an entrepreneur in the form of a PPP loan. I don't care what they did with that money. Wherever happened to that money, it ended up in a bank someplace. It ended up in a bank, right? And as a result of that, there is almost a one-to-one correspondence between the money, the quantitative easing we've seen, and overall deposits within our banking system in the United States. About a little over $5 trillion of quantitative easing turned into $4.7 trillion in new deposits in the commercial banking system and $500 billion in new deposits within the credit union situation. Okay, well, what do lending institutions do with all that new money? They do exactly what they're supposed to do. The first thing they want to do is try and lend it out. But there's just not that much demand for debt in the short run, increase in demand for debt in the short run. So most of that money ended up going into securities, buying securities. By the way, banks also, credit unions also did a whole bunch of refi and everything else. So suddenly you have a whole bunch of assets, securities, new loans, everything, by the way, at these low interest rates. Well, from an asset perspective, low interest rate means a high value for that particular debt security. What happens when the Federal Reserve cranks up the federal funds rate? Well, if you crank the federal funds rate from 0 to 5%, more or less is the same as reducing all those assets, whether they're loan assets or securities, by about 4% in value. And this is where we start to run into problems, because by cranking up the federal funds rate, the Federal Reserve has functionally reduced assets on lending institutions' books. But even that is not that big of a deal because of the fact that banks don't have to mark to market. They shouldn't have to deal with these short-term stresses. Let's acknowledge that if interest rates go up, okay, that'll have to be burned off over time. But as long as those assets are not being put up for sale, shouldn't be any problem at all. Why would a bank have to sell assets? Well, let's imagine now that the Federal Reserve starts to engage in quantitative tightening. Quantitative tightening is when you're selling off, when you're selling off the debt that was on the Federal Reserve's balance sheet, and of course, taking cash back out of the economy, in theory, putting it in the shredder and reducing the money supply. Well, when you do that, just like quantitative easing puts money into deposits, quantitative tightening takes money out of deposits. And of course, when money comes out of deposits, well, now the banks are forced to sell assets. And that is when the pain starts to kick in. Silicon Valley Bank and First Republic Bank went down for one particular reason. They are victims of geography. They're both in San Francisco. Venture capital doubled from 2020 to 2021. We're talking hundreds of billions of dollars in brand new cash flooding into the Bay Area. And of course, all those companies put that money right into bank accounts. Silicon Valley Bank is a classic example. Their deposit base went from 80 billion to 180 billion. They did what they were supposed to do in it. They put it into assets. They made new loans. The value of those loans fell. Their deposit base started shrinking faster than most because it had swollen so much. And as a result of that, bam, they got put themselves not into a problem because of bad debt. Their credit underwriting was fine. It was a complete technical default having to do with just these market numbers, these ratios on their balance sheet. This was caused to run and cause them ultimately to fail. You know, it's interesting because when you think about what the Federal Reserve's job is, right? Three things: price stability, right? Number two, full employment. No economists like that, but they made us put it in there. And number three, of course, Roger gets that. It's a little vague. Number three on that particular cut, of course, is to be the good shepherd of the overall banking system. Well, These three goals are not necessarily perfectly aligned. If you do some of one, it could be bad for another. Ergo, you have to be very cautious. You have to move in baby steps in different directions and constantly recalibrate. Well, this Federal Reserve is being run by a group of politicians who don't seem to understand this. And think about what they've done over the last 3 years. Error number one, in a preposterous panic over full employment, they blew up price stability. That's why we have inflation. And now, in a preposterous panic over price inflation, they're creating enormous unnecessary pressures on our banking system. And by the way, I love this. Fed's bar calls Silicon Valley Bank a textbook case of mismanagement. Really? I would argue the Federal Reserve is a textbook case of mismanagement. And the fact that they can't acknowledge that and they continue down this quixotic path should be worrisome to everybody. Look, if there's anything I've showed you today that should worry you, this is the slide right here. On the left-hand side, this is data that comes from the Senior Loan Officer Survey. Basically, they ask a bunch of lenders, are you tightening your standards or are you loosening your standards? Tightening minus loosening, well, that's the net percent. And right now, what it shows, and we all know this, we all know, of course, that banks are cranking down on lending. They're not lending. Your spreads over loans are going up dramatically. So it's hard to get a loan. And if you get the loan, it's becoming very expensive. By the way, this has nothing to do with you. It's not you. If you go in to your credit union, you go into your bank and you say, I need a loan, and they go, no. It's not because they don't think you're going to pay it back. It's because they don't have the money to give you. And this is the critical issue that the Federal Reserve is creating. They are creating an unnecessary credit shortage. And where this goes, how this impacts our economy, well, this remains to be seen. And this goes back to, of course, the May Federal Reserve note, where they said, hey, we may hold off on that federal funds rate of 5 to 5.25%, although we reserve the right to increase it again. Why not they increase it? Well, the stock market's bouncing back, the housing market's bouncing back. Remember all that good news I just gave you? In the Fed's world, that's bad news because it means continued inflationary pressures. But here's the thing that's most scary about that last report. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt. In other words, while they're going to stop with the federal funds rate, they're actually going to continue to reduce deposits. Now, what's interesting, what's weird here is over the last couple of months, because of the fact that they had to deal with the failure of First Republic and Silicon Valley Bank, well, they ended up in a situation by which they had to re-quantitative ease. The money supply actually popped up just a little bit, but now they're fading away again, and we're now dropping below those levels that we were at right before those bank failures began. And what I expect is over the next 3 months, things are going to start to change dramatically. And what I mean by that is you're going to see interest rates start to go up again. The only way we're going to deal with this credit shortage is higher prices for credit. That means higher interest rates. And this time, expect it's going to be on the long end of the curve. And you could add to that the big problem. Remember that debt standoff we just went through? Well, as a result of that, the Treasury hasn't been issuing any bonds for a few months. They're now going to dump about $1 trillion in bonds onto the market, again, looking for cash. So you're going to have traditional demand for loans combined with traditional movement within the bond markets, combined with a huge surge in federal debt borrowing, all in a credit scarce world. In the next 6 months, I anticipate interest rates are going to come up. And this is where I start to see problems again, because another bounce in interest rates could mean another decline in the housing market, another hit to those fragile commercial office markets, and of course, perhaps even another hit to the overall economy. By the way, what does this mean from a lending institution standpoint? Well, listen, if you're with a lending institution that has a good, steady deposit base, be loyal. This is a time where banking relationships matter, because in a credit scarce world, they're going to be taking care of their members first and foremost. So just be prepared for it to be harder and harder to get debt over the next 6 months or so. And yes, that has to do with the federal government as well. Look, we just went through all this crisis on the debt ceiling, and they finally worked it out, and we had the big workout. The joke of this whole thing, of course, is they didn't really deal with the true problem. The true problem wasn't the debt ceiling. The true problem actually had to do with the fact that we have these enormous gaps between spending and revenues, long-run spending that they had. Neither one of them has a serious plan to fix. All that craziness we just saw over the course of the next couple of months, I got this out of the Wall Street Journal. Look at the difference between the Republican and Democratic spending plans. Non-existent relative to revenues. They're not really talking, of course, about the big problem. And if you take a look at the data coming out of the CBO, recent data spells a very, very scary picture for where debt levels are going. They're saying in the next decade, you're going to see a sharp increase in overall outstanding debt. And this, of course, at some point in time, bond markets are going to say enough is enough. Now, when does this happen? When does the government start to have to deal with this? Well, maybe quicker than you think. Go back to that sharp increase in interest rates and understand how that's going to impact the sale of those treasuries, that $1 trillion in treasuries they're about to issue. It's not just actual spending that matters for the federal deficit. It's also those interest payments. Interest payments right now are very, very low because the Federal Reserve has pushed interest rates down. But now, of course, because of inflation and their anti-inflation efforts, you're going to see a big increase in these interest payments, and that could cause this day of fiscal reckoning to come sooner rather than later. Over the next couple of years, at some point in time, they're going to have to figure out how to cut spending and increase taxes. And boy, in this political environment, I don't know how that's going to shake out. So just kind of summing it up real quick, and Roger, we can wrap up with the best of these questions. The economy is fundamentally healthy. Consumer demand is plenty strong and can support the economy to put things forward. Asset prices are still too high, but that's okay because the fundamentals on those assets outside of office is the one, of course, exception to that, remain very, very solid. Our only major issue here in the West Coast, here in California, of course, is housing shortages. Where does the economy go from here? Ask Jerome. It's on him now, to QT or not to QT. Look, I've already told you, a lot of inflation is really bad. And little inflation, not so bad. Honestly, what's happened over the last couple of years, just look at the data. It hasn't hurt our economy. If anything, it seemed to have given us a nice boost. Our economy is moving forward, even with some of these geopolitical instability, even with that surge in gas prices last year. We're just overcoming it, moving forward. And by the way, all this strength can probably even help us overcome some of these issues in office space and everything else. It's pretty clear the best thing to do for the Federal Reserve at this particular point in time, sit on our hands and do nothing. Inflation will burn itself out because the money supply is no longer growing. But that's the economic reality. The narrative is completely different. We are a little less, more than a year away from what's going to be an incredibly ugly presidential election. And the party that's not in power is going to make a tremendous amount of hay out of inflation. They're going to run around and tell you how terrible inflation has been for everybody and how it's all this administration's fault. Well, the last two administrations can be blamed for that, along with the Federal Reserve, since they all voted for Jerome Powell and his policies. And in any case, it's not that big of a deal in either. But again, in these contentious times where narratives have such political power, that's probably not going to resonate, and they almost assuredly will continue to pursue this quixotic policy, look for more problems out there in front of us. And yes, you have to factor in the federal deficit, global instability, but most of all, narratives versus reality. Just quick, I mentioned this last time, but it's worth noting, beware the narrative. It's interesting. I was trained at UCLA. We called it Chicago West. We were steeped in the fundamental models of economic, of rationality, right? This idea of homo economist, where people behave in rational ways. And I think they do for the most part. But there are too many places, too many times where we see people doing things that just don't make sense from that standard model. Well, it was Robert Shiller, a Nobel Prize winning economist, who wrote this book a couple of years ago, Narrative Economics, where he discusses this. And he's very clear. You have to pay attention to the narrative because, look, when the narrative and the reality are highly overlapping, well, this is when our models work. Policymakers are doing the right thing. Politics are pursuing the right goals. consumers are making the right spending and saving decision. Businesses are pursuing the right investment decisions. But when they come off base, you got to watch out. When the narrative goes one way and the reality goes another way, well, this is when things get interesting. And I don't mean that in the positive sense of the word. This is when, of course, things get a little scary. Look, the economy is fine. It's the narrative that's broken. And that's what should worry all of us. You know, Mark Twain, it's easier to fool people than to convince them they have been fooled. Or the great enemy of the truth is not often the lie, deliberate, contrived, and dishonest, but the myth, persistent, persuasive, and unrealistic, JFK. These are things we all have to take into account. Even some of these questions that are showing up, and we'll talk more about this. These questions, again, in many ways come out of these headlines, and I understand where they're coming from. The key to, of course, to dealing with narratives is to, of course, be curious, not skeptical. Skeptical is aggressive. Skepticism is what you do with a frown. Curiosity you can do with a smile. And that, of course, makes all the difference in the world. Be curious. Understand the stories versus the reality. And remember, in the end, it's up to all of us to make sure that the right narrative is the one reaching our policymakers' ears. So I think we all need to be a little bit louder right now, as the case may be. So Roger, I didn't really answer the question. I saw one of those questions we had before was, is there going to be a recession in Q4? And the answer is...
Yeah, go ahead.
That's economic.
Well, seeing and we're kind of watching time. We're well over the time we planned, but it's been great information. I think inherently, I wasn't able to review all the questions. We'll try to follow up for those who email. I might try to take a couple, but I think a number of your comments and the topics you covered did inherently address questions that I haven't even spoken to yet. So you're a mind reader, Chris. So you do it very well. And hearing your "be curious" makes me think maybe you need to add a Ted Lasso quote, because that's one of his quotes that I love from that show. So let me maybe just think some great information just to think a number of these you have answered and some maybe we just can't get to. So let me just take a look. You talked about housing quite a bit. We talked about rates and a lot about the quantitative tightening. Here's one, and I'm just going to have to read it so I'm getting a little closer. Remember, Dr. Lacey Hunt said one way countries can work their way through large deficits is to create inflation. Thus, inflation now could be helping our overwhelming debt in the U.S. However, it seems the developed world is the same boat as we are in the race to devalue our currency, thus making it harder for central banks to solve their own country's problems. And as this notes, there's central banks in all the developed countries. So should we worry about the debt that we are creating for future Americans? I know you commented on that already a bit, especially the debt spending versus revenue, debt levels combined with the interest rates that debt's going to be under. Do you have any further comments on that, Chris?
Well, yeah, for a couple of things. There was a little bit of the questioner there. It was a great question, but there were two issues being muddled. It was when you use inflation to eat away at debt. Yes, that can have this global kind of give and take, right? Where you try to diminish the value of your currency to create say a current account surplus to help that situation. But that's not what's going on. What we're really talking about is a situation by which you basically deflate that debt away. The way to think about it is this. Think of all those people who bought treasuries at a 1% interest rate 2 years ago. Well, that treasury just went down 4% in value because, of course, the big increase in interest rates. So that's the transfer. The people who own that bond, whether it's a company or a bank or someone else, lost that value, or even people who have equities in that bank lost that value, where somewhere along the way, somebody who has a 30-year fixed rate mortgage at, say, 3%, they actually won because they now are paying a negative interest rate as a result of the inflationary surge. So you have a movement in real wealth from savers to borrowers. Now, again, in our world over the last 15, 20 years, with the big increase in wealth inequality, this may not be such a bad thing. This may not be that bad of a thing overall. Again, we have to be a little bit careful about suggesting that all inflation is bad all the time. This one might have a little bit of positive circumstances. The scary thing coming out of this is not so much the wealth transfers as much as it is, of course, is on the quixotic policies of the Fed and how that's going to be putting stress on the credit system over the course of the next 6 months or a year, depending on how far they're willing to push this.
Great. Well, and something, I think that's a great response, and something just to emphasize, and I'm biased to this, so I'll preface that in full disclosure, since I'm CEO of Nuvision. One of your comments about just staying close to your financial institution, and we hope that's Nuvision Credit Union for those at least who are on this call and our other over 150,000 members, is relationships do matter, and we really are trying
now more than ever
help our members in the good times and the not so good times. So we're here to support you through all of this. And Chris, again, number of questions. I think you touched upon many, not all, but I'm also again cognizant that we're over time due to the great content and make great questions. So for those who gave us their email and if you've identified your questions, we'll do our best to do a follow-up. One question I did see, and I think this is accurate, is I do believe we're going to be able to publish this recording. Someone had asked if we're going to be able to view it again. So I think that is our intent. We're recording it. I know I saw I can see the recording on the screen here. So we should be able to provide that. And because we also have a number of members maybe who had interest, but just weren't available at this date and time. So Chris, it's a fantastic content, great comments, really appreciate your insights. And I think we're going to do it all over again, except with more updated information on September, I think it's 7th. My screen's cutting off a little bit there. And so just looking forward to having this conversation again. And again, if we'd encourage those who attended and hopefully refer your friends and family if they'd like to join us. And we'll kind of do some updates to what we talked about in this session. So Chris, I just want to thank you, and just any final comments as we close out.
Well, no, I actually appreciate this. I think it was good to have an update, even though a lot of this content we kind of went through last time, Deb's cleaner. What I want to do next time, and I'm hoping everybody will take this with them, is that next time I think what we'll do is going to dive in a little closer on some of these sub-regional markets. So next time we'll focus a little bit on updating things, and then we'll dive more into regional stuff, what's happening in this city versus that within that Nuvision portfolio, as the case may be. So we'll make it a little closer to home, as the case may be.
That sounds great. And if we receive any other input suggestions from our members, we can take that into consideration as well. So Chris, thank you again. Really appreciate you being with us to share some outstanding information and take many questions. And we might ask for some help on our responses. We're going to do via email for the questions we didn't get to. And again, for all of our members, thank you so much for your membership. Appreciate the relationship we have with you for your business, and for taking time out of your day to spend with us. We hope this was really valuable for you, and we appreciate you. So with that, Chris, thank you to everyone. Thank you for joining us. To my team here at Nuvision, a lot of people behind the scenes to make this all work so that Chris and I can have this conversation with you. My thanks, Fong, and many others on our team who and Rob on our team who do a lot of work behind the scenes to make all this work and to make Chris particularly look good. It's hard to make me look good, but Chris looks great. So Chris, thank you so much. Thank you, everybody. Have a good evening.